What are the market conditions telling us that we should know for 2025? Stay tuned. Well, hello, everyone, and Merry Christmas. I hope you guys are having a wonderful holiday season, and we certainly are. We want to welcome you to episode 219, and this is the yearly market update, and we're going to jump right into that in just a second. But before we do, let's take care of a few housekeeping items. Number one, make sure and like this episode. You know, I noticed that when I watch somebody's videos and so on, I always love it, but I forget to hit like. So make sure and hit like, right? I'm trying to help people out, and you'll help us out by doing that as well. Share this with your friends and associates. And number two, subscribe to the Note School TV channel. And number three, hit that bell notification. And if you would like to know more about what we do at Note School, simply go to noteschool.com/TV. Again, noteschool.com/TV. With that, I want to bring on, founder of Note School, chief visionary officer, all around good guy, Mr. Eddie Speed.
Hello, Joe.
Well, hello there, and Merry Christmas.
Happy day 2 of Christmas, right?
That's right. Yeah, that's right. Yep. You guys will be seeing this the day after Christmas, and so yeah, for sure.
Call an audible on that. Don't be seeing it.
Yeah.
So 3, 2, 1. So yeah, Joe, I hope you had a great Christmas day, and so we moved out when we release our episode from Christmas Day, which would have been yesterday, to today. And we'll do that on New Year's as well.
Right.
But Joe, the most important thing here is we have gathered up what we think are the market conditions that are so critical of what you're going to need to do as a weather forecast looking into next year.
Yep.
History has a lot to do with telling us the direction of the future, right?
It is certainly the big indicator, right?
All right, so we're ready to bust it open and get after it?
Let's do it, man. Let's do it. So,
All right. Well, I don't know who that fella is there, but I don't know if he looks trustworthy or not, but we'll do the best we can with him. No, actually, here's a funny story. I've repeated this before, but I did a podcast, and they took a little episode, or took a little segment of what I said in the podcast, and when they promoted it, they did that picture right there. And so we just copied it. And I said, it's better to do the right thing at the perfect time than do the perfect thing at the wrong time. Timing, market timing. And so the way you know market timing is you got to have information. That's what this is about.
Yeah.
So, Joe, we look at the market and we say the different things. And as we enter into 25, which we're going to be into here in a week, we're going to look at different things that we've done in different cycles. I started in 1980. I've lived through all these cycles, as have you, Joe.
Mm-hmm.
But we're going to talk about what we believe makes the runway so good for us in the business. And there's some runways in other areas, Joe, that aren't so bright.
Yeah.
So let's talk about housing, Joe.
Let's do that. So this is Realtor.com's 2025 forecasts, and what we have is the forecast for 2025. Then we have the actual stats as the year ends in 2020, has ended in 2024, 2023, and back. So mortgage rates, Eddie, that's been a big contentious thing. The Fed last week lowered the federal funds rate, which is the short-term interest rate, right? That credit cards and so on are based on. And we've got a couple of slides here in just a minute when we get into banking that will show more about that. But, it's not as people have not seen the rates drop, and they probably won't to the extent that they would like to see them do that. So first of all, is mortgage rates somewhere between really 6.2, 6.3 and about 6.5, 6.8, something like that. And look at the appreciation year over year, median price appreciation. They're calling again for an upwards piece there at it's a little less than it was in 2024 at 4% and 3.7. Existing home sales going up just a tad from 4.2 million or 4.02 million to 4.07. And then the year over year inventory increasing about 11.7%, Eddie.
Well, Joe, let me just tell you this. I'm not as optimistic in some of these numbers as realtor.com is. And the reason I'm going to say that is this. The existing inventory year over year went up 25% last year.
Mm-hmm.
And they predicted it was going to go down 4.4.
Mm-hmm.
Right? So I think they missed the ball pretty bad. 30 points, I would say, is a problem.
That's a big stretch.
There's over 20 states that are north of 30% increase, including Texas and Georgia and the Carolinas and Florida, right? So understand that we're reporting it because we're saying that's what they said. But I'm saying to you that there's other forecasts out there that hedge fund level players operate with that we have some access to.
Yeah.
And their predictions don't look quite like this. Yeah. So I don't want to, I could be wrong and I'm not scared to be wrong. Yeah. Right. In other words, but I'm saying like they're showing appreciation and listings year over year. They're going into the market with an excessive amount of increase in listings. Like and they called the ball last year saying the listings were going to go down. Well, sorry, that isn't what happened.
Yeah. And then they're showing rent growth down a bit as well. So yeah, we'll see how that, and that's what we're seeing in the marketplace right now.
Yeah. And this is the thing I want to make a point of, Joe, is if somebody has a different view than what we think, or there's conflicting views of like, we're trying to be fair and throw the ball down the middle and say, we may see it one way and there may be, advisory groups that advise a lot of the big Wall Street level firms one direction, and realtor.com or Fannie Mae may see it
another, and blah, blah, blah.
Yeah. It's a weather forecast, but there's the European model, Joe, and this model. You know what I'm saying? It's the same thing, right?
Yep. And so that line that's going across there is kind of showing what the average is there. The dotted line is showing back from October, and I put the other line in there for actually what's going on right now. And then you see as it goes through the end of the year, they're saying it's going to go up a little bit, then it's going to level back off again. So we'll just have to see how these play out.
Yeah. So they're saying that we're going to see a decline and then we're going to spring back.
Yeah.
Right.
And then we're going to see by the end of the year, which is it's the 12th month of 2025, then that's going to kind of level back down to just a little above what it is now.
So they're predicting not starting out the year very good.
No.
Right. And you can see that. And then they're saying things are going to level off in here about halfway through the year. Okay. Does everybody see that?
Yeah. And that's in price. That's a pricing forecast. And average right now is about 402, something like that. Yep.
Yeah.
Okay.
Okay.
So the affordability, well, you can see that, Eddie. That almost looked like the mirrored the mortgage credit availability index that we followed for several years, but I don't think it's ever been lower. Well, it hadn't been lower since 1999.
Well, here's I would say, Joe, affordability is, I think, the key to it. This is why new home builders are certainly in a terrific strain. Right. Yes. They're really, really in a strain. Lennar's reported spending almost $50,000 per house in buyer incentives. Right.
And I've got a great slide. We've got a great slide there in just a minute.
So and we believe that's why the listings are up year over year as affordability. And it's a little bit why we're kind of going like, it's interesting that realtor.com is making the predictions that they make. Right. So affordability is a factor for sure. Now, Joe, Got a lot of squigglies here on this.
Yes, we do. And so the blue line is the household formation. And then the black line is the single family housing starts. And what Goldman is saying is that formation has exceeded single family, and they're about 1 million houses short. But, Eddie, we know that there's almost 5 million houses out there in the marketplace that really aren't for sale because they could be Airbnbs, they could just be sitting vacant. There's an anomaly in all of these numbers today.
Hey, Joe, can I ask you a question? I'm listening. Yeah. You see that right there? I'm listening to you.
Yeah.
If they keep saying we have all these shortage of houses, how come we have builders that can't sell houses and existing inventory has gone up 25% in a year-over-year listings?
Yeah. Yeah.
Right. So I'm a little bit of a contrarian today, Joe.
Yeah. And this, I certainly am too. I mean, how does that figure? Right.
Yeah. So this is what we need according to them, and this is what we have. Right. The black line is what we have and the blue is what we need.
I don't know that it's a numbers problem as far as number of houses. I still think it boils down, Eddie, to an affordability piece.
Joe, inflation trumps supply and demand.
Mm-hmm. That's it.
That is what I've concluded. Inflation trumps supply and demand.
That's it.
All right, lot of predictions here from the big
this
boys.
Is from Citizens JMP and consumer. Expect option. The opinion is that they're saying that. And by the way, Citizens JMP is one of the largest investment banks in the U.S. Investment banks. And this is just some things from them. And they're saying that people are starting to kind of fall into the new normal, as they call it. And we just know it as, it's just kind of getting back to normal with the rates where they are. But mortgage rates spiked up in October to 6.5, and then they'll carry through the end of the year. And home buyers are slowly moving off the sidelines, which is the other piece of that in the next one down there. And talking about seeing mortgage origination volumes.
I want to point this out.
Yeah.
We believe that Citizens is pretty squared away bunch of guys.
Yes.
This is what they're saying.
Yeah.
Home sales volumes and mortgage originations decline even further than they've been in 2025 and 2026.
Yeah.
That is not a reflection of the numbers that we just heard from Realtor.com.
And Goldman, yeah. Goldman's pretty sharp too.
So understand that, and we particularly think that Citizens is a pretty sharp bunch of guys. We know some high-level folks that pay a lot of attention to how they predict things. So we'll see. Joe, somebody's going to be right.
There's enough information out there that somebody is going to be right. Oh my God. This would have been 300 slides long.
All right, Joe, you're killing me here with this one. You're killing me.
I know, right? So this is just the highest volume real estate brokerages out there. And those numbers, I showed those because every one of them are showing that sales are up at those different brokerages. The red one there is Anytime Real Estate, and it's up 234%. And then you've got Compass there, you've got Remax, you've got Redfin, and they're all showing the brokerage. The last 12 months is the LTM performance, and what that's looked like from November of 23 till the end of 24. All of them show up.
Well, I'm glad for them. We've got Note School is full of people that are realtors, and their full-time gig is realtor, and their part-time gig is note buying. So I'm glad for them. Yeah. I don't believe that the market is pacing with the demand, but I'm thrilled to see that their production numbers are up.
Yeah. Yep,
so
absolutely.
Good for them. We'll always hope realtors can always get more sold, right? And they're way behind the numbers of where they need to be as an industry. So let's just keep hoping.
Yeah, almost anything would have brought it up at that point. Right?
It was ugly for a while. I agree with that.
Yep, for sure.
Good chart there. All right, Joe.
Homebuilder
on this page.
Yep. So look on to the far right there, and that is interesting. That's the cancellations in Q3 for this year. And so those are people, they thought they had them sold, but they didn't. And we've got Horton, which is the bigger Lennar. They just announced today that their expectations for the first quarter of next year is it's not going to look like they beat the expectations. They're saying we're going to miss them next
Well,
year.
I saw a report back in the fall that DR Horton's cancellation rate in the height after 2011 reached 28, and they are at 21.
Yeah, it's huge.
So the cancellation rate in the whole time, and the incentives and all of that stuff. And by the way, these are a lot of these, most of these are public companies, or they are.
Yeah, Lennar is the 139th biggest traded company.
You go look at their stock. You go look at their stock trends, and you can see that there's a lot of concern in this area of the industry. New home construction is not selling, and they've given away the farm to do it, and they're making less profit,
lower prices, higher incentives.
They're not matching what Realtor.com said. Can we say that right, Joe?
Yeah, that's right.
Like Realtor.com's reflection and appreciation and going up and stuff, that's not what we're seeing there. Are we calling for any kind of a major bomb? No. But we're saying that if you look at the trends here, it gives a reflection of, we have our head on a swivel right now entering into this next year, Joe.
Yep, we do.
Okay.
There's your existing home sales on the left, and we can see how they just, continue to fall. And you see that the new home sales, but what they're having to do, the Pulte's and the Lennar and the DR Hortons, is they're lowering their prices, right? And they're raising their incentives, so they may lower their price. They've lowered their prices by 5 to 10% over the last few months, and we know that the incentives are almost 50% or $50,000, and they're buying down rates and giving away granite countertops and all those things. So
Joe, I drew you a little line there.
Yeah.
Starting in June.
Yep.
And I basically said, while this looks good, in the same era, they have drastically changed their pricing. So they did something to move the inventory, even if they weren't making money.
Yeah.
So and that's what existing home sales is not doing.
Yeah.
Right.
So Mom and Pop can't offer any buy downs on rates, right?
You can. You just got to get off the dollar.
Yeah. And they're still reeling over the fact that I've got a 3% rate, and whoa.
Yeah. All right, Joe. We have been watching this closely. This chart has been pretty interesting to watch all year. And we talked about earlier, these are listings year over year, right?
Yep.
So I'm going to circle some areas that I think are worth noting, because that has been a hot spot right there.
Yep.
Right. Also, when you look at, like Tennessee,
mm-hmm.
Right? You look at Texas, you look at Arizona, you look at our friends on the West Coast, and South Dakota's looking great, Joe. I'm not making fun of my friends in South Dakota.
No, North and South, yeah. And Nevada, they're down a little bit.
Here's Colorado. When I start looking at it like this, these are the states that we're hearing about all the time. Man, it's rocking here and stuff, and there's some concerning numbers, up in the Northeast as well. But let me tell you something: the Sun Belt states down south, and I'm going to say Arizona, Texas, all the stuff, Tennessee, and North Carolina and South. They're not selling.
Yeah.
This is the percentage increase in listings year over year for the month of November.
Yeah.
Okay. So average, it's 125%. But if you look at what's average, meaning the population and what has been the leading industry trends, they're trending higher than 25%, Joe.
They are, and these numbers are just so all over the place. It's like, people kind of look at it and they go, "What in the world's going on?"
Well, there's no houses to buy in South Dakota, Joe.
No, there's not. Well, there's only what 2,000. Yeah.
Enough said. Enough said.
Enough said. Enough said. Yep.
All right, let's talk about the banks.
So this is what the experts say going into 2025. That's our Note School logo is over that. But, the experts say, and these are some pretty smart guys, they're saying 73% are saying we're going to go up, and that's in the dark blue. And the light blue says that going to stay about the same, and only about 18% are saying we're going to see the rates go down. I kind of agree.
Well, I would say, Joe, that this is what I hear the Wall Street level players saying as well. And they are saying that, it's going to be more of the same. And Joe, I don't know what to think, because every time I read a Facebook page, there's all these real estate Facebook pages, and there's all these people with these hot sports opinions. They aren't reading this data, Joe. They're betting with their heart. They're betting on the Cowboys are going to make it to the Super Bowl. Okay. I live here in Dallas, right?
Yeah.
You can bet with your heart, but it may not be a good bet.
Well, and the quote there below from a gentleman from Bankrate, he's, given the recent run up in the 10-year treasury rate, I expect mortgage rates to follow upward, and we'll get some more clarity. I think, we got to get the new administration in, and then we've got to see if, the Fed because the Fed can they operate independently.
Well, can I be political?
You can. A little bit.
Look, I believe that Trump is going to lead us to a better economy than we would have had. But there are things that Trump coming in can't immediately fix.
No.
Right. And so if people go in like, yeah, Trump's in there and he's going to fix this. And it's like, and I believe that his policies will be better for business and better for the economy.
I do.
That's a belief. Like, and if I've gone all the way through lots of things and never been a guy that wore my political beliefs on my sleeve. But I think from a business perspective, that's a truth.
Yeah, I do.
Okay?
Yeah.
And the second thing I'm going to say to you is I don't think he can go in there. And I think Chairman Powell has done a good job managing rates, even though it was some very unpopular decisions.
Yes.
I'm not so fired up about how they've managed the banks.
Right.
I think they've swept a lot under the rug, and I think it's going to unpeel next year.
I do too. Yeah. That's what the data shows. Yeah.
And so more to come about the banks.
And you
mortgage
see
rates are about a 7, isn't that right?
Yep. And it is what it is, and people are looking. Oh, it's going to go down. It's going to go down. One has nothing to do with the other in reality. What the Fed does with the overnight rates, and the banks do with the mortgage rates is two different. It's not one. They really don't wash each other's hands, right?
Joe, everybody said the arm was going to take over again because of increase in rates, and there has been no worse prediction ever made.
Yeah, it's never been great.
It is like the loan production is terrible. The rates aren't hardly any less. There's nothing about it that's proven it. It's cheaper to get a 15-year fixed rate than it is to get a 5-1 arm.
Yeah. Yep, it is.
So I'm going back when we were seeing people like this, it's what's going to happen. It's what everybody's going to do. And that it just hasn't proven to be true. All right. Another boy, you got realtor.com all over the place.
I did. And this was kind of I like the one, the vertical line there is just, that is today. And then the end of the last piece there is December of next year. So a year out. But that still doesn't put rates below 6%. And that was my point there.
So Realtor.com is predicting a decrease in rates.
Well, they're somewhere by the end of next year, or by the end of 2025, about 6.2 to 6.3.
So they're in direct conflict with what Citizen says.
Yeah.
And they're in direct conflict with what did you say about over 75% of people predict?
73% said we expect rates to go up. Now, this is a year out. So
you're going to cause me to get hate mail from Realtor.com. You know that, Joe.
And they love us, Eddie. They love us. Maybe they'll listen to us.
All right, let's roll it up here.
Yeah, let's roll it up. So, Fed open market, the Fed met last week, and their target rate for the overnight borrowing rates, again, the short-term rates, 4.25 to 4.5, they are at that. Chairman Powell said it was a close call, but he thinks it was the right call to lower rates, 25 basis points. But then on the bottom, he said the Fed indicated that it probably would only lower rates twice in 2025. And I think people were looking more like 4 to 6 out of the 10 meetings that the Fed will have in 2025.
And here's another thing, Joe, just to point this out, it's a little bit Captain Obvious.
Mm-hmm.
Mortgage rates are driven by 10-year bond rates, not by Fed rates.
Not by, yeah.
10-year bond rates have not followed the line that the Fed rate has followed. By the way, it didn't follow the line, Joe, when rates started going up either. You remember that?
Well, and the Treasury, the 10-year Treasury, the Treasury takes care of paying all the bills, collecting all the taxes, and so on, and managing the Fed funds rate. That's basically the separate committee that monitors the money supply.
Yeah. Yeah. It's the rate they charge to banks. So
that's right. And the crazy thing is they're almost the same. And that's kind of what this slide and the next slide. This is the Fed fund rate at 4.5 as of yesterday, as of last week. And and then you look at the 10-year Treasury, which is on the next slide, and they're about the same. Typically there's a little bit more of a spread in there.
Hey, Joe, I want to show you something interesting. Look at 2008 all the way 2016. That is an 8-year period.
0.
And so what I think you're going to see is more of this.
Yeah.
Just a possibility.
Yep. And then there's the 10-year. And the 10 years at 4.566. Look at what it was in September there, Eddie. So the one completely, look at that. And it was.
Okay, Joe, this chart, which is the 10-year Treasury, if I did a layover of the exact same time frame, when we saw Fed rates dropping right here in the exact same time frame, now go look at the Fed rate, and we were here, and now we're at here.
Right.
So we've jumped up a lot in rate as the Fed rate has gone down. We're only pointing this out to say that this is what drives real estate. Fed rate really doesn't drive real estate like the 10-year Treasury rate does.
This is what, the 10-year is the long-term, the long-term forecast, and that's what it is. Yep.
Fed rate has done this. The 10-year bond rate has done this.
That's it.
So we're just trying to. It's a weather report. We got to know what the characteristics of the storm are, right? So we have every reason to believe that seller financing is going to continue seeing its pretty phenomenal growth.
Yep.
And so this is why we say that the runway ahead of us looks good, because when all this happens, what really we see, Joe, is this: we're filling the gap conventional lending doesn't fill.
That's our deal. That's our space.
That's our thing, isn't it?
Yep.
All right, let's talk about commercial real estate. I guess things are going good over there, right, Joe?
Well, I thought I'd just throw this in there from Housing Wire. the FHFA, the Federal Housing Finance Agency. It's right there in front of me, right?
Yeah.
They're going to raise the loan limits on multifamily loan caps for next year, Freddie
Well,
and Fannie.
Can I tell you why I say they're going to do that?
Yeah.
Because they know the banks aren't going to be loaning money on multifamily.
Yeah, that's right.
And so, but they've already clearly stated they're not rescuing the multifamily situation.
And there's about $1 trillion in multifamily loans that are coming due in 2025.
Yeah. So a lot to be said, but I can understand in the circumstances them raising the rates. That didn't mean they changed their underwriting, Joe. Their underwriting is tight, right?
Real tight. Yeah.
Yeah.
Yeah,
So
for sure.
But they're going to increase it a little bit. All right, let's talk about the foreclosure situation.
Yeah, so foreclosures soar 48% nationwide. Look, California is 238%. New York and Florida, 48 and 49% respectively. Office and multifamily have the greatest. Office is still the biggest. We'll see that in special servicing in just a second. In the foreclosures, and of course, overbuilding, higher interest rates, increasing expenses, aging Class C properties. It's added to the current situation.
Guys, you can fact check us on this. We have been monitoring this situation and calling this ball for more than 2 years.
Mm-hmm.
When it looked like we had lost our mind.
Yeah.
Like what are you talking about? There's a problem. And we've been calling the ball on it. Everybody knew there was a problem in office, and we've been calling the ball on multifamily.
Yep.
Office was Captain Obvious, so to speak, right?
Yeah.
So, Joe, there are a lot of trend lines here, but they all seem to be going in one direction.
Well, the one that we really want to talk about here is the multifamily, which is that yellow line there on the bottom, and we see that special servicing rate continues to climb in November, with office and multifamily hitting new highs, and that's it. They're all up except for lodging.
Yeah. So I'll just do a red line under the bottom of it, if that makes sense.
Yeah.
This is what Joe is referring to right here.
Yeah.
And that's multifamily, which is here.
Yep.
Right. And so the answer is, we know that office and lodging and those things, that's all the case. I'll tell you an interesting thing is that it looked like retail didn't really have a problem, right?
People enjoy going out again, I guess, and going.
Yeah, but when you look at the trend line here, it's not going in the right direction.
No, it's not. Nope.
And so the trend line here in retail, which is right here, the trend line here, and that doesn't look very good as well. And then the dotted line is just the overall average. Yeah. You can't really average it.
No, you can't.
You got multifamily, where most of our audience has money invested if they're invested in syndications. Yep. Most of it, right? And that is why we paid the most attention, because we thought that people that related to our industry, the money they had at risk was the most money was probably out in multifamily. And we, as I said, we've been calling that ball for a while, and we're not beating up our friends. We're just saying it's a weather report. Like, if you got a category, you're in Florida, Joe, you got a category storm, category storm that's a 4 coming at you. What do? Not watch the news because you don't
watch it every minute.
Yeah.
This is the special servicing rates. And again, you can see there in the multifamily category, which is about midway down, at 12 months, it's gone from 3.25%. These are loans entering into special servicing, which means delinquency has more than doubled in the last 12 months.
Yeah, this is a big time watered down number. The problem is way bigger than this. I don't talk to anybody in the industry that thinks
just kicking the can, right?
I don't know that anybody thinks it's a real number, but whatever they're reporting has gotten twice as bad. Right. I'm not sure they're reporting the whole story, but there you go.
For sure. But there you go. So this was a post. You sent me this the other day.
Yeah.
And if you can kind of do your own math. He says, my $100,000 investment just disappeared. $24 million in total investment simply vanished. Wasn't a Ponzi scheme. It was a large apartment complex that was lost in a foreclosure. And the fella says, looking back, I don't think there's a single thing I'd have done differently. Said, I reviewed the sponsor's track record. They had owned 3,000 units and full cycle on several similar deals and had exceeded the projections every time. Flew out, looked at the property, talked to people, talked with several people that had invested in the partnership, and the property had a variable rate loan. This was in April of 2022, and the Fed had just started. Yep.
Joe, what happened was market timing.
That's what it was.
It wasn't that the operator was bogus.
No.
It wasn't that it was a big scam. It wasn't that. It was market timing.
That's all it was.
It's better to do the right thing in perfect timing than to do the wrong thing and I'm the perfect thing in bad timing. Like these guys did have a good track record. That's why I sent this to you.
Yep.
I'm just showing this is one of mega thousands of stories of a guy that says, I'm a savvy investor. I knew how to investigate them. Everything they did was good. You cannot beat up market timing. It is the most important variable. And I just thought it was a little life lesson there.
Well, April of 2022, it was here. Now it's here.
Well, I know I sound pessimistic, but what I'm trying to sound to you is the things that we're showing you, the predictions that we're showing you, we're not making up the predictions. We're just reporting them to you.
As they are. Yeah.
This is not a prediction. This is a result.
That's it.
God lost his money, and a lot of other people did too. Yeah. Right? Non-performing loans. Joe, I'm going to say this to you, okay? As we start into this last piece, non-performing, Joe, there are 800,000 loans that are in a lost category.
Yep.
There's 1 million loans that should not probably be in a foreclosure situation yet.
Yeah.
Right. Their level of delinquency doesn't mean that they should maybe all be dumped into foreclosure.
Yep.
There are 200,000 loans that are in foreclosure that are 1,300 days delinquent thereabout.
Mm-hmm.
But there's 800,000 loans. These shouldn't be in foreclosure. These are in foreclosure, but there's 800,000 loans that are in never land.
Yeah.
And I believe that they're going to snap next year.
I think so too. You got to do something with them.
Yeah.
It's got to be an outcome there.
So you see these reports like this and it goes, delinquency, it's up a little bit. And so it's not soft delinquency. It's not current delinquency. That's the problem.
No.
It's old delinquency. That's the problem. Legacy loans.
Right?
All right.
And this around a little while.
Look, do the math. There's 2 million loans thereabouts, right?
Right.
I'm going to lay this math out for you. If I can get the right pen going here. There's 2 million loans total.
Yep.
There's 1 million loans in here. And these are that they should they be in foreclosure? No, they're not. They're not candidate for foreclosure.
Not there yet.
So you kind of follow what I'm saying here.
Mm-hmm.
But the problem is you take this math and subtract it from this math right here, and all of a sudden you've got a lost category. And there's only 200,000 loans that are in foreclosure. The bad news is, oh my God, there are almost 1,500 days delinquent. It's jumped crazy amount.
300 days. Yeah, almost 365 days this year because they've just been sitting there. That's almost 4 years, Eddie.
In other words, there is this right here is the problem. That is the elephant in the. It's the one that's swept under the rug, and I believe that is going to pop out this coming year.
I think so too. Opportunities ahead.
To you, there's some level of soft delinquency. There's some level of stuff that's on the conveyor belt and seriously crazy delinquent, almost 4 years delinquent.
Yeah,
and so it's not fixable. But what about these loans in here that they're not saying what level of delinquency they are?
Right. Well, that's it, man. Let's see. We want to thank everybody for voting for us, Eddie.
Yeah, we had a great year. We won 3 categories. Best Distressed Note Buyer. Hey, Note School TV. Never lost in this category, right?
That's it.
We've won every year as Best Podcast, and our trade show, Note Expo, has won every year at Best Note Trade Show. So thank you, industry, for recognizing us.
Yeah.
We really, Joe, you said it right. Like give us a thumbs up, give us a comment, share it with people. Like, we think we are trying to lay it at the middle. I'm not trying. We are in a good cycle in the note business.
We are.
Okay, let me be clear about that. These negative market conditions are good for us. When banks are in trouble, that's great for us, right? When there's distress, that's good for us, right? So the activity level in our business is popping out through the top for these obvious reasons. But the key thing I want to be clear about is we discuss tonality. We discuss, like, we don't ever want to say things like that are exaggerating what the truth of the market is. Just the market conditions right now are trending highly in our direction. When they're not trending highly in our direction, we try to be fair and call the ball on that too. Right. Joe?
Last slide, Eddie. Merry Christmas
to you, brother.
Yep. Merry Christmas.
We are going to have a big year, I believe, in the business. I know it's a little long on the show, but there is so much stuff that was relevant to it. Joe, I'm going to let you close us out. Happy New Year, everybody. Belated Merry Christmas.
That's right. Thank you. Thank you so much for all the support you've given us this year. We really do appreciate you, and we appreciate you staying in, hanging in there with us every week. And we'd love to see you in 2025, guys. Noteschool.com/TV. Again, noteschool.com/TV. Our January 1st, Wednesday is next Wednesday is January 1st. And we'll have our the first episode of 2025 will come out on the 2nd, which is next Thursday. So, guys, thanks again. Continue to enjoy your holidays, and we'll see you soon. Thanks.